Hi, so my name is Cormac Leech. Just started at Victory Park Capital. I realize that I am basically all that's standing between you and lunch, so I'll try and keep this short and sweet. So at Victory Park, I'm going to be focused on looking after the UK Investment Trust and also help sourcing deals across Europe. Before Victory Park, I was at Liberum Alternative Finance as a co-founder and director of basically their peer-to-peer focused effort. And over the last couple of years, we raised about £1.2 billion for a couple of investment trusts, PTBGI, Ranger, Honeycomb. And before that, I've been a banks analyst for about 10 years. And I think that 10-year period, looking at the likes of HSBC, Standard Chartered, really kind of focused my mind that actually there's got to be a better way to do credit. And when I found out about peer-to-peer, I kind of got super interested in it. This presentation, I thought it would be helpful, given some of the drama over the last 12 months, to talk a little bit about volumes, returns, but perhaps more importantly, sector sentiment. And then also talk a bit about some of the infrastructure developments that have been happening, and some of them I've been putting a fair amount of my own time into. And then finally, just how do I see the outlook? Giles talked about calling this peer-to-peer. I'd rather call it online direct lending, because I think a lot of people just seem to kind of confuse the issue and think peer-to-peer actually means a very narrow definition. So this chart, I won't focus on this too much, but basically, big picture, this sector is actually very, very large. It's over $300 billion globally. And of course, 90% of that is China. So, if any people actually, want to really get into where the action is in the sector, I'd encourage you to look at China, go to LendIt China and so on. I've been meaning to go to China, LendIt China for a couple of years, but never actually got around to it. I'm going to go next year. I think you cannot afford to ignore China if you're interested in this space. And incidentally, eventually, I think US and Europe will catch up, but so far China is really running away with the volumes. So I want to talk about sentiment. And I don't know about you, but the lazy way that I've been kind of measuring sentiment in the sector recently has been to look at the Lending Club and on-deck share prices, and it's not a recipe for feeling good about the sector. The IPOs 2014, the shares are down 60 or 70%, and over the same period of time, surprisingly, the volumes have more or less doubled. But if you looked at these share prices and you didn't do any fundamental work, you'd say the sector is really struggling. Not really true. It's more about unrealistic expectations at the time of the IPOs. And there are some indications, by the way, with Lending Club, with recent corporate governance issues, they seem to be being put to bed. And touch wood, these share prices will start to recover. The other key barometers I think that people look at perhaps are the UK listed investment trusts, the likes of PTBGI and VSL, the Victory Park Specialty Lending Vehicle. Again, from IPO, you can see that, frankly, the share prices have struggled. Dan, price to NAV for PTBGI and Victory Park is about a 15 to 20% discount. And again, if you just looked at these, you would say, wow, this sector is really struggling. Again, that's actually quite misleading, and I'll show some data later to show why that's the case. So what's going on with these investment trusts? So part of it is actually around accounting, believe it or not. So the way that these investment trusts are required to account for marketplace loans is under Ifrs Accounting. They hold them at amortized cost. Now, that worked really well for the first 6 or 12 months. If you write a loan, as pretty much everybody in this room knows, the loss curve initially is pretty shallow. So for the first 6, 12 months, if you hold it at amortized cost, it looks like things are going actually really well. And you can see that with PTBGI, the share price initially actually traded up to a 15, 20% premium to NAV. People are looking at the return saying, wow, this is great, nothing to worry about. Of course, when you go into year 2, the loss curve steepens, and all of a sudden under IFRS accounting, it looks like these investment trusts can't do anything right. The performance is really weak, and everyone's going, wow, I really regret putting money into this. Share price falls, and that's where we are right now. So I would encourage people to kind of bear with these investment trusts and kind of, obviously I'm talking my own book here because I'm working for Victory Park, but there is a very strong logic, if there are any accountants in the room, that over time the profile of the loans will normalize such that you have a blended weighted average of new loans and older loans. At that point, you're going to see the returns start to come through, so you have a more representative seasoning profile across the loan book. And there are, of course, some other short-term issues. Brexit and the volatility in sterling forced these investment trusts to hold an unusually high level of cash recently. As sterling weakens, they need cash to pay to their FX brokers, and that basically has been a drag on returns as well. So a few reasons, and so important to also say, of course, that the underlying loans have not been shooting the lights out. If you look at Lending Club Prosper, I think by virtue of a wall of capital looking to come onto the platforms, They probably, frankly, got a bit greedy, went for too much growth, and you saw some gross yield compression And of course, that came back to bite them, particularly in the lower credit grades. But what you're seeing now, of course, is the Prosper Lending Club really starting to reprice the loans up. You know, if you look at the last couple of presentations, quarterly presentations from Lending Club, they're consistently talking about repricing those loans up to get to the kind of expected returns that investors are expecting. So a lot of the issues that are dragging on investment trusts currently, frankly, are genuinely very high probability they're short term. And I think it's just a matter of time until we see these investment trusts kind of turn the corner and start to re-rate. Interestingly, Funding Circle's investment fund has already done that. You know, it was at one point trading at a 10% discount to NAV. It's now at a 2 to 4% premium. So, you know, I think hopefully that's kind of the bellwether, and the rest of the investment trusts will follow suit. So a lot of the stuff around the negative sentiment, you know, if you're feeling lazy and you're trying to gauge how well the sector is doing by looking at market prices, first of all, I would caution you, you know, that's not necessarily going to lead to the right conclusions. And secondly, I think those market prices will recover over time. So, you know, similarly, growth has been a bit subdued. You know, if you look at top right is volumes in the US, 6 monthly volumes, and you can see that, if I can read my own right, the growth's basically annual, half on half, slowed to about 13% from about 90%, you know, 2H15 on 2H14. And that's really about the credit quality not really coming through, and investors, hedge funds, institutional investors pulling back a little bit. But again, that's very likely to be short term as these platforms actually reprice more appropriately for risk. Elsewhere, you have seen a little bit of a slowdown. You know, the UK slowed down, half on half slowed to, you know, just over 40%. And I think there's a couple of dimensions to that. One is that a lot of the growth for the UK platforms was coming from investment trusts like P2PGI, Victory Park, and so on. As these funds have started to trade at big discounts, they no longer can access the market to raise more capital. Therefore, the amount of raw material that's coming into the UK platforms has slowed. The other thing is that I think, frankly, around Brexit and so on, the UK platforms tightened their scorecards a bit, just being a bit cautious about credit quality. You heard that, you know, in the panel just now. So some of the issues that have kind of slowed down the volumes, I think, are temporary, and you know, we will see a bounce back in growth, I think. Incidentally, continental Europe, I kind of continue, I don't know if you remember last year, I was expecting continental Europe to gradually overtake the UK. I think that is still on the cards, but probably takes a little bit longer. But it's interesting to note the volumes in continental Europe growing at over 100%, you know, in the first half 16. So the slowdown we've seen in the US and the UK hasn't really hit Europe or indeed China. So, you know, so obviously we've had some dislocation and some, I would say, kind of, I'm not sure trauma is the right word, but, you know, it hasn't felt great in the peer-to-peer sector recently. It's important to note this has been against a backdrop of incredibly benign macro conditions. So if peer-to-peer is struggling in this environment, you know, we really need to make some adjustments, I would argue. US and UK unemployment at a 10-year low. Real yields. Now, when I was a banks analyst, one of the best indicators of what credit quality was going to be like over the next couple of years was to look at real yields. If real yields are low or negative, basically, you don't need to grow your business or grow your income to service your debt. Inflation basically just reduces the real value of your debt naturally. So the fact that we've got negative real yields of 2% in the UK points to an incredibly benign environment for credit risk in the UK. Forget about Brexit. You know, Brexit's going to hammer sterling, yes, but credit quality in the UK, I'm actually very, very optimistic about it. And you know, as a consequence of that macro environment, you're seeing credit card delinquencies at very, very low levels. You know, the yield on high yield, UK and US, very tight spreads. So very benign macro environment. And perhaps unsurprisingly, as a consequence of that, you're seeing returns from the large UK platforms, the guys who were just sitting on this panel, actually very solid in the 5 to 7% range. Here we're looking at the LARI, it was called the Liberum Alternative Returns Index, and basically Liberum doesn't do any of the work, it's all done by AltFi data. And the index is calculated as a time-weighted, principal-weighted blend of your portfolio. The easiest way to think about the LARI, it's basically the return you would get on your portfolio if you basically invested £1 every day, you know, consistently for 3 or 4 years. Then the LARI would be the return you would be seeing every day when you look at your portfolio. It's not perfect because it's purely quantitative. It makes no predictions about future seasoning on the loans, and therefore it's not actually possible to invest and achieve the LARI. Basically, to work out the effective IRR from the LARI, you probably need to take 30 or 40 basis points off it. You know, I've been kind of bitching about that to AltFi data for a while, but basically they don't see any easy way to fix it without making some subjective judgments, which they hate to do. But in any case, I think what's interesting is we are in the range 5 to 7%, and Funding Circle, I think, is perhaps the most interesting line here, the red line. You can see that it had a bit of a bungee jump early 2013, but it since has come roaring back. And I think that's a little bit of self-help. I think, frankly, they've improved their underwriting model. They probably have better data. but frankly also it's probably related to a very strong macro position in the UK. When you dig into the Lowry, so basically here we're looking at loan losses on the same kind of time-weighted, volume-weighted basis. We're just looking at the loan loss trends for the last couple of years. Funding Circle, again, has shown a very marked improvement. I don't know if you remember a couple of years ago I was having a go at Funding Circle for generating only 2 or 3% IRRs in 2011. They've made a marked improvement, I would say. So basically it bodes quite well for Funding Circle currently. RateSetter similarly has had quite a stable performance. I suspect there's probably some mix shift going on in the portfolio, maybe where they're going for a slightly riskier credit, but nevertheless the loan losses seem to be moving sideways, which bodes well. AltFi unfortunately don't have the data for Zopa, so it's not possible to do the same analysis, but we can do it before the safeguard fund. So I just included some data on Zopa around the GFC. You can see on this Lowry basis, the loan losses never really got above 2%. So the basic picture from the UK is that actually these platforms are actually in pretty good shape from a credit point of view. And the asset-backed security market is noticed. So if you look back in May, we had the Funding Circle securitization, and then last month we had the Zopa securitization. And I think it was really quite impressive. The underlying Zopa loans do about 4.8 to 5% yield. But if you actually look at the securitization, and by the way, it got very good ratings from Fitch and the other rating agencies. But if you actually look at the data and work out the weighted average cost of capital implied by where they actually got the securitization done, you come out with the number 4%. To me, that's a really interesting number because it shows you're basically getting an extra 80 basis points or so of yield for free relative to the risk that you're taking. Remember, asset-backed security professionals do a ton of work, and they've really looked at a very granular basis open. They've decided effectively 4% is the quantum of risk that you're taking, if you will. It's the yield equivalent to the risk. You're getting 4.8, so you're getting an extra 80. And of course, Zopa has, this is their first securitization. So, every reason to think 12, 24 months from now, Zopa is perhaps, 50, 100% larger than it is today, and the market is more familiar with it. I think that you're going to see tighter spreads on the securitization. So I think very good chance we start to see a weighted average cost of capital for Zopa, all else equal, of 3.5%, which implies 125 to 150 basis points of free yield you're getting investing in the loans. So of course, over time, you can guess where I'm going with this. We should expect the yields that you achieve on Zopa to come down closer to the ABS market. Otherwise, there's an arbitrage, and ultimately arbitrages don't persist forever. To me, this is actually a really important result because it bodes quite well for the sustainability of the online direct lending space. I don't know if any of the guys from Deloitte UK are here, Neil Tomlinson or Margaret. Anyway, they did a really interesting piece of analysis back in May. And the title was, is marketplace lending a temporary phenomenon? And it's really kind of made me scratch my head because they'd done a lot of work. It was like a 40, 50-page PDF, a lot of analysis. And basic conclusion was that marketplace lenders can't really compete with the banks because, yes, operationally they're much more efficient, but in terms of funding costs, they can't compete with the cheap deposits that banks achieve. So here, it's just a waterfall. Basically, the conclusion is the cost economics for a bank doing unsecured consumer loan is about 800 basis points. When you factor in, do the same analysis for a marketplace lender, but factor in the higher funding costs, you come out at about 815 basis points. Therefore, marketplace lending is fundamentally on the back foot when you're going after prime customers. I think the flaw in this, and it kind of relates to the previous slide, is that over time the funding cost for marketplace lending is going to come down closer to where we're seeing the asset-backed security market. So that red bar needs to come down, and you can see it on the right-hand side. Basically, it needs to come down by about 150 basis points in my view. And furthermore, I think there's another angle for the marketplace lenders. I think they've been missing a trick, frankly, in terms of cross-sell. If you look at the left chart, the green bar is the assumed benefit that banks achieve from cross-sell according to the Deloitte analysis. In the middle bar, in the middle graph, you can see Deloitte not giving any credit to marketplace lenders for cross-sell. I think there's an enormous opportunity for marketplace lenders in the UK and globally to start cross-selling aggressively to their installed customer bases. Think they have very technology-savvy borrowers and lenders that they've accumulated over a long period of time. There's a huge opportunity to sell them investments, insurance, consumer goods, and I think that obviously lowers your cost of making a loan. So when you factor all of this in, it looks like marketplace lenders can be 25% more efficient than banks, even going after the highest quality borrowers. And of course, there's more to this because the Deloitte analysis is really comparing banks that have already reached scale. They've got their economies of scale, whereas marketplace lenders still, frankly, quite nascent and fledgling. So when marketplace lenders get bigger, you'd expect economies of scale to come in. The operational expense gap will tilt further in favor of marketplace lenders. And then finally, it's worth pointing out that banks are not doing particularly well at the moment in terms of returns on equity. You know, we've all seen what's happening to Deutsche Bank and so on. So I think there will be pressure on banks incrementally, particularly as they're encouraged to hold more and more capital to reprice their loans upwards. So if anything, you know, the sustainability of marketplace lending is actually going to become more pronounced going forward. So we looked at the economics and they work. You know, so fundamentally, you know, if we can manage the idiosyncratic risks in our marketplace lending, absolutely works. However, there is one major elephant in the room, and it's called platform fraud risk. You know, so I'm sure there are no fraudsters in this room, but you know, fraud has been a major issue. And frankly, I've been working in you know, this sector for the last 3 years. And personally, the most negative experiences I had have not been around credit risk, they've been around fraud risk. Personally, I invested in TrustBuddy. That didn't work out very well for me. But also, you know, I've invested a lot of time working on projects with some platforms that turned out actually to be effectively fraudulent. And there are different shades of it. You know, one is basically you take the money off the lenders and you put it in your own pocket, siphoning off cash. Most spectacular example is Uzaibo in China, $7.6 billion loss. TrustBuddy was a less severe shade of fraud, where basically they were robbing Peter to pay Paul. Paul wasn't doing very well on his loan portfolio, so they take some of Peter's cash to basically, you know, reimburse Paul. Same net effect, you lose your money. The least severe type of fraud, information fraud at Lending Club, obviously that didn't work out very well for the protagonists, and it obviously damaged the brand. It is still a going concern, but fraud risk, I think, cannot be ignored. I think, you know, fraud risk will potentially frighten away investors. If marketplace lending wants to really become institutional scale and take a very substantial amount of total credit intermediation, it has to solve fraud risk. So how to solve it? One obvious way is regulation. Now, FCA, SEC, CFPB are all obviously looking at marketplace lenders more closely than they ever have. Perhaps more importantly, institutional scrutiny is increasing. You know, the likes of Victory Park, PTPGI, Roses, Honeycomb, you know, the other professional money managers, obviously going through these platforms in a significant amount of detail. And when they invest in a platform, it's normally a very good indication that actually things are working pretty well. And before they pull the trigger, invariably they will get forensic accountants to, you know, look at a very granular level of detail in terms of all of the operational risk and operational processes, the likes of Baker Tilly, Altus, Strategic Investment Group. So, you know, there are some obvious lines of defense, and then obviously we've got periodic audits from PwC and so on. The last item on this page to mitigate against fraud, I haven't seen it yet, but I think it would be a fantastic product if it was available. Basically, to get commercial insurance from insurance companies with the premiums paid by the platforms themselves that pay out 100% to the investors in the case of platform fraud. And obviously, as a consequence of this, you would have insurance companies sending large teams to the platforms to actually scrutinize and make sure that everything is working as it should. So these are kind of the old tech solutions, if you like. But there is a new tech solution. So peer-to-peer is fundamentally a financial technology. You know, perhaps unsurprising that the best possible solution is, again, a financial technology product. The idea here is, you know, an independent data repository that basically tracks all of the cash flows for each individual loan, down to the level of movement of cash in and out of bank accounts of the borrowers and lenders. If you track the cash, it basically becomes virtually impossible for the platform to start misappropriating cash. And of course, you know, this data repository would track all of the loan information, who owns it, and so forth. There are a couple of innovative companies in this area. Global Debt Registry, for example. Factory is much earlier stage, but you know, they are moving in this direction. And I think this is the killer app that basically would completely eliminate platform fraud risk and therefore would start to crowd in and attract more capital to the space. So I'll just touch briefly on cyber risk, another major issue. You know, we also what happened with MT Gox in Japan, you know, $350 million stolen. I think with online lending, it's probably more about hackers getting their hands on private, you know, high-value personal information, bank account detail from lenders and borrowers. But I mean, there are kind of obvious solutions: penetration testing, encrypting data, and so on. And the infrastructure is in place. So a lot of the necessary infrastructure around fraud mitigation and cyber risk is rapidly coming into place. Kind of briefly talk about some other infrastructure that we're starting to see come into the peer-to-peer space it's a very high value add. Kind of outside the scope of this presentation, but you know, I would like to draw attention to some research providers like Allenbridge and Intelligent Partnership that are starting to write research reports, helping investors make decisions which platforms to work with. Analytics companies like AltFi Data, PeerIQ, distributors like LGBR Capital, Octopus, and perhaps most importantly, some of the peer-to-peer aggregators, like NSR Invest, Goji, LendingWell, in which I'm an investor, by the way. But basically, these guys are giving efficient, very convenient, low-cost access into the peer-to-peer space. And I think this infrastructure will be key to really driving peer-to-peer kind of to the next scale, if you like. So I've talked a bit about the infrastructure. I'd like to kind of take a step back. I think certainly for myself and possibly for other people in this room, I think it's quite easy to get too much into the weeds and forget about how peer-to-peer compares with other asset classes. So this is a chart I've used before, by the way, but basically the top is really looking at peer-to-peer returns. The blue is the peer-to-peer returns. These are proxies for peer-to-peer, by the way, but using Federal Reserve and Bank of England data over 20 years. But the key conclusion is you get mid to high single-digit returns if you invest in direct lending to consumers and SMEs, and basically no down years, which is the key point. If you look by comparison at commercial property or equities, yes, you get slightly higher returns, maybe 8, 9, 10% returns, but look, you had 2 periods in the last 20 years where you suffered a 30% drawdown in capital. So however you want to look at a Sharpe ratio or risk reward, I think it's obvious looking at these charts, peer-to-peer lending is actually very attractive relative to other asset classes. And then zooming in, a bit more on the last 4 years. So this is really just comparing the returns you can get investing in the Lowry with investing in equities or fixed income equivalents. The blue line is the Lowry. As we saw earlier, it's kind of tracking around 5.7, 6%. The black line is the earnings yield on the S&P. So basically what I've done is using Bloomberg data, taking the rolling next 12 months earnings per share from the S&P and simply divided by the S&P index. And that's kind of a good, kind of pretty crude estimate of what kind of returns you can expect investing in the S&P. Strictly speaking, you should probably add about 1% to that to kind of reflect the growth in cash earnings, but it's a pretty good proxy. What you can see is from the beginning of 2012, the earnings yield on the S&P has kind of moved down from 10% closer to 6%. But I would encourage you to look at the gap between the black line, which is the S&P earnings yield, and the Lowry. So you can see, it was a little under 4% back at the beginning of 2012. It's now within 0.2 or 0.3%. Basically, I would argue there's never been a better time in the last 4 years to switch money out of equities and put it into peer-to-peer loans. You come to the same conclusion, but it's even more stark if you look at European high yield. If you go back to the beginning of 2012, high yield was giving you about 11% returns versus 6% for the Lowry. Look at it today. European high yield, no doubt due to the ECB and Mario Draghi, aggressively doing QE. But European high yield is now basically at 3%. You basically have the gap has swung from a +5 to a -2. So again, there's never been a better time to sell speculative European Union high yield bonds and switch that money into peer-to-peer. So the relative value is certainly there in spades, I would argue, at the moment. So that's kind of it. I mean, to conclude, I think online direct lending has had a rough 6-12 months, but I would argue extremely likely to bounce back. The cost advantage relative to banks is certainly there. The infrastructure is being rapidly put in place around fraud risk, due diligence, connectivity, and the relative value is there. So frankly, I see no reason why, a decade from now, consumer, peer-to-peer can't be 30, 40% of consumer and SME lending. Thank you. That's it.